Do you agree? It's more about EM and Europe?
No, because we think that you're in an environment where global economic growth is slowing. You've actually got a risk of, a probability, we would say, of US recession. And in those environments where markets come under pressure, historically, the US equity market continues to outperform. The dollar continues to outperform, Alex.
So on the flip side, talking about the 2020 outlook, Goldman Sachs has theirs. And part of it says that, look, the Fed cuts are going to bleed through the economy in a good way. So it should be easy financial conditions. They think tariffs have peaked. There's a bottom of the inventory cycle, the idiosyncratic events like oil prices moving will stabilize. How do you think of those things?
So what we have is the fact that the ISM, you're looking at CEO confidence, these are at levels that are recessionary levels. And yet, so far, all we've got is interest rates down 0.5% year on year. Normally, if you get that kind of scale of slowdown, interest rates come down 400 basis points. Bond yield come down 200 basis points. There's a lot more monetary easing that needs to be done to rescue this economy because, CapEx in the US has been down for the last 2 quarters. It's down 1.3% year on year, quarter on quarter. So we're looking at an environment where if unemployment starts to rise, and announcements like the WeWork announcement this morning, that's not great news for the US economy. Earnings, you're going to have an earnings recession in the United States. You've already got negative earnings year on year. People are ignoring this. And what's happened is that all this rise in the equity market has been multiple based. And that only works if economic growth picks up or inflation starts to come down and that mix of inflation and growth gets better. We don't think that's the case.